So let's stick on the investing theme. A very common question we get that does depend on people's personal circumstances. Again, you might be seeing a theme here, but tell us, I guess, how you would think through it. And this is relevant for both Bryce and I because it's a decision we face. Offset account v investing. People's mortgages these days probably have a 6 in front of them. The long-term average of the stock market is, 8 to 10%, but you got to pay tax on that. So how do you think about the choice between putting more in your offset or investing in the stock market?
It comes down to your goals, like you said, right? I'm a financial advisor and I like goals. But when we look at this, it is about what your future outcome that's sought is. And yes, on a very black and white level, your 6.25% after tax is a very attractive return. And for a lot of people, that is actually a really good way to save money and feel secure at the moment whilst those rates are high. A couple of things that people don't necessarily realise all the time when we're talking about percentage rates on offset accounts. That percentage rate and the amount that you have in your offset, it reduces the interest payment and increases the principal payment. So you're not paid the 6.25% on whatever you've got in your offset. It just comes off your debt. Now, in some cases, that might be available as redraw, but not a lot of people are taking that money out of their redraw and going and spending it in the same way that you might have that investment. The other thing is that with your house, it has a limited capacity to compound. What I mean by that is that once it's paid off, the only benefit that you then have of not having a mortgage is the cash flow that you would otherwise be allocating to that mortgage. Now, we use debt recycling a lot for clients where we take out additional equity and then we recycle the income from that back through the debt to help pay down or effectively build a portfolio of assets that is greater than what the value of the mortgage is and pay it off faster. And the reason that that's a good strategy is because you can use debt on your house that isn't tax deductible, turn it into tax deductible debt. And so your effective interest rate now is comparable to your effective rate of return after tax.
How soon into your property journey can you start looking at debt recycling?
Well, there's a couple of things.
Asking for a friend.
Asking for a friend. So one would be, depends how much money you've got in the bank or in investments. So theoretically, you could take everything that you have in the bank and you could pay down your mortgage, and then the next day you could go and take out a new loan and you could invest that.
And then, okay.
But suppose that you don't have hundreds of thousands of dollars sitting in the bank.
Well, then it's a case of at what stage do you have the equity available in your property? We generally won't do it for people unless they have sort of $100,000 plus or they have existing investments with us.
Okay, so it's not about the percentage of the mortgage you've paid off. It's more about a hard number of 100,000 plus.
Well, that's because it costs money to set it up. It costs money to maintain it. And we generally won't do it unless it's going to be valuable for the client.
You want to be generating enough decent income from the investment to meaningfully contribute?
That's right. And so in the same way that with a, say, 30-year mortgage, where obviously you pay a lot more interest up front, and then when you get to the later stages of that mortgage, you're paying a lot more principal off. Well, your initial stages of compounding, you're probably saving more into your investment than you are earning money from that investment.
Yeah.
But fast forward 10 years, that investment's probably earning at a faster rate than what you're even able to save in it. Mm-hmm. And that is the amount that's then effectively paying off your home loan. And so it gets, as I say, it gets fairly complicated fairly quickly, but at 8 to 10% compounded, and particularly if you can use, if you're thinking about aiming to pay off debt at retirement, so you can use high capital growth assets and then draw them down in a lower or no tax environment, there's a real benefit of maintaining a mortgage that's tax effective throughout your working years and then drawing on tax effective investments when you get there.
Just because I know that we just used a heap of jargon, heaps of numbers, and it is easy to get lost in that. I think the takeaway for people is if you've got a few $100,000 of equity in your home, you should go to equitymates.com/advice, put your details in, and we'll put you in touch with one of our recommended advisors for a no cost, no obligation initial meeting, and you can get them to step through what debt recycling is in a little bit more detail and ask more questions, because I hadn't really heard about it until we started getting questions on the podcast about it a couple of years ago. But you start to do the maths and it's seriously powerful. I mean, so much of like getting ahead in your personal finances in Australia is figuring out where the tax not loopholes, but the tax opportunities are.
Yeah.
And this one for me is just like a massive free kick to existing property owners. But you know what? If you're an existing property owner, I don't begrudge you for using it. Like until some of these things change, do you?
Yeah, definitely. I mean, yeah, the tax system is designed to charge people the exact right amount of tax based on their circumstances. Nobody's out there, I mean, I'm sure there are people out there who are trying to dodge tax, but use what you have to your advantage. So take your position and make the best possible decisions, whether that be with investing or with tax or with, you know, saving for education or whatever it might be. But everything with planning and everything that we're talking about, it's all about figuring out what your best outcome is and then doing that with the things that you already do.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.